There's all sorts of advice being passed around on social media right now. When it comes to tax advice, some things may actually be too good to be true. Let's see if that hot tip you got is tax-backed or tax crap. Tax-backed or tax crap. Buying equipment is treated differently than leasing equipment when it comes to tax deductions. Well, that is tax-backed. The deduction for equipment works differently depending on whether you buy or lease. Generally speaking, when you lease equipment, you'll deduct the payments that are made as you pay them. Pretty cut in your eye. When you buy equipment, however, you're going to deduct the cost of that equipment over several years through depreciation. Depreciation is the deduction of the cost of equipment over time based on the asset's useful life. You can speed up depreciation with bonus depreciation or Section 179 elections. This can let you deduct more of the costs up front. Let's look at a quick example. Assume you have a piece of equipment that costs $25,000. If you lease the equipment for 5 years, deduct $5,000 each year for your taxes. If you buy the asset, your deductions will be based on depreciation for each year. If you elect to take a Section 179 deduction in the first year, you'll be able to write off the full cost of the equipment in that first year. The total deduction is $25,000 for both leasing and buying the equipment. Purchasing the equipment allows you to accelerate those deductions and save you tax immediately. Whether you lease or buy will depend on several factors, including your cash flow and business goals. Reach out to an hourly Silverstein professional to work on a strategy that maximizes your tax savings. If you want to know if your tax tip is tax-backed or tax crap, leave a comment down below and give us a follow to stay up to date.